Debt financing is when a company raises money by borrowing. Think of it like taking a loan from a bank or issuing bonds to investors. The firm promises to pay back the principal plus interest on a regular schedule. Equity financing is like inviting new partners into the business. The company sells shares and the new owners get a claim on future profits, dividends, and voting rights. Debt holders have priority in a liquidation. They get paid before equity holders, but they do not own a piece of the company. Equity holders share the upside if the firm does well, but also bear the downside because they are paid after debt. In simple terms, debt is renting money, equity is selling a slice of ownership. The weighted average cost of capital, WACC, blends the cost of each capital source in proportion to its market weight. Formula: WACC equals open E over V close times RE plus open D over V close times RD times open 1 minus TC close, where E equals market value of equity, D equals market value of debt, V equals E plus D equals total firm value, RE equals cost of equity, often from CAPM-RD equals pre-tax cost of debt, yield on bonds or loan rate, TC equals corporate tax rate, interest is tax deductible. Numerical example: suppose a firm is worth $100 million, financed with $60 million equity and $40 million debt. Cost of equity equals 10%, pre-tax cost of debt equals 6%, tax rate equals 30%. E over V equals 0.60, D over V equals 0.40, 1 minus TC equals 0.70. WACC equals 0.60 times 0.10 plus 0.40 times 0.06 times 0.70 equals 0.06 plus 0.0168 equals 0.0768, which is 7.68%. This is the hurdle rate the firm must earn on new projects to add value. The WACC is used in discounted cash flow (DCF) models to discount free cash flows to the firm (FCFF). The Modigliani-Miller theorem provides two landmark propositions. Proposition 1: no taxes. In a perfect market, a firm's total value is independent of its capital structure. Formally, V sub L equals V sub U, where V sub L is the levered firm value and V sub U the unlevered value. Debt merely reshuffles cash flows between debt holders and equity holders. It does not create or destroy wealth. Proposition 2: no taxes. The cost of equity rises linearly with leverage because equity becomes riskier. RE equals RA plus open parenthesis RA minus RD close parenthesis times D over E, where RA is the unlevered cost of capital. With corporate taxes, interest is tax deductible, creating a tax shield. The revised Proposition 1 becomes V sub L equals V sub U plus TC times D. Proposition 2 adjusts to RE equals RA plus open parenthesis RA minus RD close parenthesis times D over E times open parenthesis 1 minus TC close parenthesis. Example: assume V sub U equals $200 million, RD equals 5%, D equals $80 million, corporate tax equals 30%. Tax shield equals TC times D equals 0.30 times 80 equals $24 million. V sub L equals 200 plus 24 equals $224 million. The firm gains $24 million just by using debt because it can deduct $4 million of interest, 5% of 80, from taxable income each year. These results are theoretical. They ignore bankruptcy costs, agency problems, and market imperfections, which real-world firms must consider. Trade-off theory says firms balance the tax benefits of debt against the expected costs of financial distress. The optimal debt level is where the marginal tax shield equals the marginal distress cost. Pecking order theory, also known as the Myers-Greenspan model, argues firms prefer internally generated cash, then debt, and only issue equity as a last resort because issuing equity is seen as a negative signal that the stock may be overvalued. Exam-style comparison question number 1. List 3 assumptions underlying the trade-off theory and 3 underlying the pecking order theory. Exam-style question number 2. A firm has $500 million of retained earnings, a tax rate of 35%, and an investment project needing $600 million. How would each theory dictate financing? The answer for the trade-off theory is that it would compute a target debt-to-equity ratio and might issue debt up to the optimal level. The answer for the pecking order theory is that it would first use the $500 million of retained earnings, then raise $100 million of debt before considering equity. Exam-style question number 3. Which theory better explains why high-growth firms often have low leverage? The answer is the pecking order theory, because high-growth firms quickly exhaust internal funds and want to avoid sending a negative signal to the market. These types of questions test conceptual understanding and the ability to apply the theories to real scenarios. The tax shield of debt is the present value of the tax savings from deducting interest. For a perpetual debt level D with constant interest rate RD, the annual tax shield equals TC times RD times D. Because the shield is perpetual and tax rate and debt are constant, its present value equals TC times D when RD equals the discount rate for the shield, typically the cost of debt. Illustrated calculation. A firm carries $50 million of perpetual debt at 7% interest rate. Corporate tax rate equals 30%. Annual interest equals 0.07 times 50 equals $3.5 million. Annual tax shield equals 0.3 times 3.5 equals $1.05 million. If we discount at RD equals 7%, present value of shield equals $1.05 million divided by 0.07 equals $15 million, which is also equal to TC times D equals 0.3 times 50 equals $15 million. If debt is not perpetual, we discount each year's shield. Present value equals the sum of TC times RD times D sub T divided by 1 plus RD raised to the power T. The tax shield adds directly to firm value in the APV adjusted present value framework. Financial leverage amplifies both gains and losses. The degree of financial leverage DFL measures the sensitivity of earnings per share EPS to changes in earnings before interest and taxes EBIT. Formula: DFL equals percent delta EPS over percent delta EBIT equals EBIT over EBIT minus interest. Sample numbers. Suppose EBIT equals $40 million, interest expense equals $10 million, 1,000 shares outstanding, and net income before tax equals EBIT minus interest equals $30 million. Tax rate equals 25%, so net income after tax equals $22.5 million. EPS equals $22,500 per share since 1,000 shares gives $22.5 per share. If EBIT rises by 10% to $44 million, interest stays $10 million, new net income equals $34 million before tax, $25.5 million after tax. EPS equals $25.5 per share. Percent delta EBIT equals 10%. Percent delta EPS equals 25.5 minus 22.5 divided by 22.5 equals 13.33%. DFL equals 13.33 divided by 10 equals 1.33. Matching the formula 40 divided by 40 minus 10 equals 1.33. Higher DFL leads to higher ROE because equity gains from the extra profit after paying fixed interest costs. However, if EBIT falls, EPS falls faster, increasing bankruptcy risk. From this explanation, you just need to break them into segments, and for each segment return phonetic or reading style of the segment. The optimal capital structure is the mix of debt and equity that maximizes firm value or minimizes weighted average cost of capital. A simple quantitative method uses the trade-off model. Maximize V equals V sub U plus TC times D minus F of D, where F of D is the expected cost of financial distress, often modeled as a quadratic function. F of D equals alpha times D squared. The target debt level satisfies. TC equals 2 alpha times D star, therefore D star equals TC divided by 2 alpha. Computation example. Assume corporate tax rate TC equals 35% and distress cost parameter alpha equals 0.001. That is, each dollar of debt squared adds $0.001 of expected distress cost. Target debt D star equals 0.35 divided by 2 times 0.001, which equals 0.35 divided by 0.002, resulting in $175 million. If the firm's total value unlevered is $800 million, the target debt-equity ratio equals D star divided by V minus D star, which is 175 divided by 800 minus 175, equals 175 divided by 625, equals 0.28, which corresponds to 28% debt and 72% equity. In practice, firms iterate, using market data on credit spreads, Z-scores, and industry benchmarks to fine-tune the ratio. Explanation: the Altman Z-score predicts bankruptcy risk using 5 financial ratios. For a public manufacturing firm, Z equals 1.2 times X1 plus 1.4 times X2 plus 3.3 times X3 plus 0.6 times X4 plus 1.0 times X5, where X1 equals working capital divided by total assets. X2 equals retained earnings divided by total assets. X3 equals EBIT divided by total assets. X4 equals market value of equity divided by book value of total liabilities. X5 equals sales divided by total assets. A Z-score greater than 2.99 signals a safe firm, less than 1.81 signals distress. Exercise: a firm has working capital 30 million, total assets 200 million. Retained earnings 40 million. EBIT 25 million. Market equity 150 million, total liabilities 120 million. Sales 300 million. Compute X1 equals 0.15, X2 equals 0.20, X3 equals 0.125, X4 equals 150 divided by 120 equals 1.25, X5 equals 1.5. Z equals 1.2 times 0.15 plus 1.4 times 0.20 plus 3.3 times 0.125 plus 0.6 times 1.25 plus 1.0 times 1.5 equals 0.18 plus 0.28 plus 0.4125 plus 0.75 plus 1.5 equals 3.1225. Since Z greater than 2.99, the firm is considered low risk, suggesting it can safely increase debt without breaching covenant limits. Debt covenants often require a minimum Z-score or a maximum debt over EBITDA ratio. Failure triggers penalties or forced repayment. 2 main valuation frameworks handle different capital structures. 1. WSCC, discounted cash flow approach, assumes a constant target debt-equity mix. Cash flows are discounted at the WSCC that already reflects tax shields. 2. Adjusted present value, a PV, separates value into A. Net present value of the project if it were all equity financed using the unlevered cost of capital, and B. Present value of financing effects such as tax shields, subsidies, and costs of distress. Comparative example: a project requires $100 million investment, generates perpetual cash flow of $15 million. Unlevered cost of equity equals 10%, debt cost equals 6%, target debt over equity equals 0.5, corporate tax equals 30%. WSCC method. Value equals debt plus equity. Let equity be $66.7 million, debt be $33.3 million, debt over equity equals 0.5. WSCC equals E divided by V times 10% plus D, divided by V times 6% times 1 minus 0.3 equals 0.667 times 0.1, 0 plus 0.333 times 0.06 times 0.70 equals 0.0667 plus 0.0140 equals 8.07%. Present value equals cash flow divided by WSCC equals 15, divided by 0.0807 equals $186 million. Value added equals 186 minus 100 equals $86 million. A PV method. Unlevered net present value equals cash flow divided by unlevered cost of capital equals 15, divided by 0.10 equals $150 million. Present value of tax shield, perpetual debt, equals tax rate times debt equals 0.3 times 33.3 equals $10 million. Adjusted present value equals 150 plus 10 equals $160 million. The The difference arises because a PV assumes the specific debt amount is permanent, while WACC assumes a stable target mix. Both are correct if assumptions match the reality. Explanation. Below are representative MBA-level exam questions that cover all 10 topics. Conceptual 1. Define debt financing and equity financing. Discuss one advantage and one disadvantage of each from the perspective of a senior manager. Conceptual 2. Explain in plain language why the Modigliani-Miller theorem states that capital structure does not affect firm value in a world without taxes. Conceptual 3. Compare the key drivers of the trade-off theory and the pecking order theory. Which theory better predicts the capital structure of a fast-growing tech startup? Why? Conceptual 4. Describe how the Altman Z-score is used by lenders when setting debt covenants. Quantitative 5. WACC calculation. A firm has market values equity 120 million, debt 80 million, cost of equity 12%, pre-tax cost of debt 7%, corporate tax 25%. Compute the WACC. Quantitative 6. with taxes. Given an unlevered firm value of 500 million, debt of 150 million, corporate tax rate 35%, calculate the levered firm value using the proposition with taxes. Quantitative 7. Tax shield valuation. A company issues a 10-year bond of 40 million at a 6% coupon. Corporate tax rate is 28%. Compute the present value of the tax shield assuming the discount rate equals the bond yield 6%. Quantitative 8. DFL illustration. EBIT 30 million, interest 8 million, tax rate 30%, 2,000 shares outstanding. Calculate DFL and the percentage change in earnings per share if EBIT rises to 33 million. Quantitative 9. Optimal debt level. Using the simple trade-off model V equals VU plus TC times D minus 0.001 times D squared, with VU 800 million and TC 32%, determine the debt level that maximizes firm value. Quantitative 10A. A PV versus WACC for a project requiring 50 million, perpetual cash flow 7 million, unlevered cost of equity 9%, target debt 20 million at a 5% cost, tax rate 30%. Compute project value using the WACC method. Quantitative 10B. Compute using a PV. Quantitative 10C. Briefly comment on why the two results differ.